Good morning, and thanks again for joining us for Tecnoglass's Q2 earnings call. We again were able to deliver record revenues this quarter. As you can see, we were able to grow our revenues 33% year over year to a record 225 million, mainly driven by strength on the commercial segment, but also growth on the single family residential segment, which we're going to go into more detail a little bit later. Record revenues on the residential segment to 87 million, despite some of the headwinds that are going on out there, were driven mainly by our repair and remodeling, as we'll discuss later. Going down the P&L, we were able to gain quite a bit on the gross margin line year over year. We were able to expand gross margins by 520 basis points. In line with previous quarters, that's driven by operating leverage, automation, some favorable pricing dynamics, and efficiencies. If you were to look at the operating profit margin, we were able to gain 620 basis points year over year, so a very favorable comparison. From an adjusted EBITDA perspective, we were able to grow that 55% to a record second quarter, 85 million, which was very encouraging. And from an EPS perspective, we were able to increase that from 69 cents last year to $1.12 this year. So all the way through the P&L, a very positive quarter for the company. Moving forward to the backlog, the tendency continues. The pipeline continues to be robust, and I think that's mainly driven by secular trends, positive demographics in our main markets. And we were able to expand backlog to a record of 797 million, almost 800 million, out of which roughly 2/3 of that is related to multifamily work, which is clearly outperforming some other areas like office and lodging. The U.S. continues to represent 95% of backlog, and as a result of this continued growth, our book-to-bill continues to be well in excess of 1x, which is encouraging for the foreseeable future and moving into 2024 and almost the beginning of 2025. Honing in on single-family residential, it was up 15% to a record 87 million for the quarter. That accounted to about 40% of total revenue, which is kind of in line with the trend as to how the revenues have split up in the last few quarters. Again, driven by positive demographics, migration into the Southeast and in other states where we have a strong presence, and the fact that roughly 2/3 of what we're doing is repair and remodeling. And as we have heard, throughout the last few weeks, there's a deficit of inventory, right? There's people that are not willing to move right now because of low interest rates. So therefore, home builders are having to build up to address the growth on population and migration tendencies and whatnot. So that is also driven a lot of activity from an R&R front of people that are not moving to new homes, but essentially staying where they live. If we go into the revenue bridge, it was an all organic, as it has been in the past, all organic growth of 33%, with commercial leading the way, growing about 50% year over year. And that's driven by different factors. Obviously, again, secular trends, positive dynamics in the Southeast, where we have our strongest presence, some encouraging signs in other places in the U.S., and there's also the fact that there was some pent-up activity during COVID of projects that just didn't take off and are now breaking ground. So that's also helping out. And again, residential contributed 15%, still a very healthy growth year over year, despite the headwinds that we're seeing out there from a macro perspective. Moving on to the EBITDA bridge, there are some positive pricing dynamics as well, based on the last price increase that we did last year around May. So price always, has contributed in the last 3-4 quarters, but mainly it is volume that is delivering, that growth, that healthy growth that we're delivering quarter over quarter. From a margins and cash flow perspective, The story continues. As you can see, over the last 2-3 years, we have increased gross margins by about 20%, which is very encouraging. Invested a lot on automation, which has driven a lot of efficiencies. We've gotten a lot of operating leverage on the business. The fact that we continue to grow into the residential segment where we don't do installation work is also accretive to margins. And as a result of that, as you would expect, our cash flow has improved dramatically and continues to be the case. This quarter in particular had a seasonal effect because we paid all of our income taxes from 2022 during the second quarter of the year. That being said, Q3 and Q4 are expected to be very strong cash flow quarters, given that we don't have any income tax payments then, and that our investments in growth capex are essentially completed. So we see a step down on capex the remaining of the year. From a returns perspective, we introduced these metrics a couple of quarters ago because we think it's important for shareholders to take a look as to what we're returning. And essentially, if you look at our return on equity and you benchmark that against the industry, we're well ahead. We're returning about 28% versus the industry benchmark of about 11%. And from a return on invested capital, the story remains the same, essentially. We're more than double what the industry's at, being at 7% and us being at 15%. So the investments that we're making on CapEx have very quick paybacks, very high internal rate of returns. And as a result of that, you see us returning, very, very healthy margins and very high value on our investments. Finally, from an outlook perspective, we are raising the guidance based on how well we have performed through June. We are raising the guidance to revenues of $830 to $855 million, which accounts for about 18% all organic growth at the midpoint of the guidance. And we are raising our adjusted EBITDA to $320 to $335 million, up from $265 million last year, which equates to about a 26% all organic, again, growth year over year. So with that, I leave you and thank you for joining us again. Hope to see you in the next quarter. Goodbye.